Hey, this is Andrew Kuhn, and you're listening to the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, timeless investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along. Hello, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focused Compounding, here for your favorite investing podcast on the planet. Sitting next to my co-founder, Mr. Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How is it going with you?
It's going great. We hope it's going great for everybody else. Hey, if this is the first time that you are tuning in with us, checking in with us, be sure to hit that subscribe button, thumbs this video up, leave us a rating and review, and check out all of our other content. Go to focuscompounding.com. Geoff blogs about 2 to 3 different stock ideas every single week on the premium side of things. So be sure to sign up there. It is $60 a month. You can cancel anytime you want. So be sure to check that out. Also, we manage capital for investors at Focus Compounding Capital Management. Click the Invest With Us tab on our website, focuscompounding.com. Lastly, the famous Gannon Gazette goes out every 2 weeks, and you get a free stock idea and in the email. So be sure to sign up for our email list on the homepage. Again, that is focuscompounding.com. So in today's podcast, we're going to be talking about mistakes. And we've done a mistakes podcast in the past. And obviously, it's very productive to rub your face in mistakes and do a little bit of a post-mortem. And we can even talk about not just mistakes when it comes to ideas, but just mistakes in general of habits, stuff like that. So we're coming to the end of the year. Yeah. And I don't want this to be a total post-mortem on 2019. Okay. But what do you think are some mistakes, both, investing, but also with the process as well, that you think you've made in 2019? And what are you going to do to get better about it?
Well, that's a hard one. Mistakes, let's see. So recently, we've had a very bad quarter in the last quarter of this year where we had a very good first 3 quarters. And the big stock declines were in our biggest position, NACO, and in a smaller position, but still big position, Necker. Not big for us, but big by anyone's standards that it is on us. I would say that one of those was not a mistake, NACO, and the other one, Necker, was. Okay. That was my mistake. Picking that stock and buying it. And what happened there is, one, it was the sum of the parts thing. And as you know, you have a sticky note that says, when thinking SOTP, sum of the parts, think STOP. Stop.
That's right. I saw that on Twitter, and I like that.
Yeah?
Yeah, I did.
Yeah.
I like that. It's a sticky note on my computer screen.
Yep. Yeah. So, and we work together, so I can see that sticky note all the time. That's useful. In general, some of the parts things have been a problem for us, for me. We bought a couple things last year that either didn't do much of anything or went down. And certainly, on average, things that have been tied to asset stuff for us has done much worse than things that are tied to
Why do you think that
things.
is? I mean, were they more popular back in the day, you think? They've kind of changed now? I mean, because so in the Q3 letter, you wrote about Trinity Park Holdings, right?
Trinity Place Holdings, yeah.
What is it?
Trinity Place Holdings?
Yeah, Place Holdings, sorry. And that
which we don't own, and we
do not own. No, we did not buy.
We talked about it because of the fact that when I was talking to you about it, you were like, I don't really want to see something that's an asset play.
Yeah, and since then, they came out with an offering. I think they're doing an offering for more common stock, in the stock sold off more, something like that. Why do you think some of the parts situations are attractive to you, other value investors as well, not just you? And then why do you think they tend to kind of be crappy situations, I guess you could say, or at least from our experience? Yeah. It's a very, do you think it's very Ben Graham?
It is very Ben Graham. We have to be careful with all of these is that they're not necessarily super cheap. The sum of the parts thing works out okay if you have an appraisal that's very, very low. I don't mind buying asset plays when there's a great deal of safety to it. I bought a bunch
like
of
a good business attached to it?
Well, sometimes, or an incredible cheapness. But the good business thing is helpful in a few ways. One is solvency stuff. So when you were talking about with Trinity Place, Maui Land and Pineapple would fall into this category. Cool, the timber company that we talk about sometimes, would fall into this. They produce very, very little or no free cash flow or no cash flow to fund their assets. So if they need to develop or something, they would need to borrow or issue shares or something like that. Now, Necker was different. Necker is a little complicated situation because I did not get involved in buying the stock until after a deal had closed. And then the party that had sold the company to them, bought the company from them, didn't agree with their adjustment to what had happened to the value of the company in the time between when the deal was agreed upon and when it closed. So the closing price was a disagreement. That is very rare. It's very rare.
Very common.
Very common to have small adjustments. They happen all the time. Almost all deals include adjustments for things like how much your borrowing from the bank was, your seasonal borrowing was at that time, how much inventory you had on hand. Lots of things are like seasonal type things and stuff. They're small adjustments. This was like a third of the value of the deal or something, and a huge percentage in terms of the cash that the company had left. So we like Necker as a business, but the difference in the price between a pretty high price for the stock or not a low price and a very low price was the cash that was on hand from the sale. And there's a reason why I didn't buy the stock before the deal closed. But in that case, obviously, the deal closing wasn't enough of a guarantee. To me, I thought that after the deal closed that it was safe to know what the amount of cash they had on hand would really be and stuff. And now it's in dispute. Yeah.
And, it's been an interesting experience for me because for example, Necker, and we talk about this all the time. The best stock to own is the one where you feel comfortable just not getting updates on the company all the time, right? And Necker was a company where, we have been and were very much so following the situation day to day. And that's no fun to do.
Right, exactly. And that's what like special situations investing is like all the time.
And you compare that to a company like OTCM, CSVI, a couple other companies that we've talked about on the podcast, and you could feel virtually certain, even if you maybe even pay too high of a price, that in 10 years, the stock or the business itself is going to be larger than it is today.
Yeah. And from the times that I've done things in different asset plays and stuff, it is much more sort of like being an insurer or something. You buy a basket of these things with the expectation that they'll work out over time, and they will, as long as nothing you don't expect happens. And
maybe that's the difference. Is that a lot of people that like you take like the Benjamin Graham approach to it was he didn't really concentrate on these plays. It was much more of a diversified portfolio.
Yeah, he would own like up to 100 different stocks and things like that. The other thing though is Graham would buy things that were much cheaper than these things, and that's where we have to be careful. These are all things that we're looking at where they're not cheap on price to book. Most of these, not all. But like Necker, the cash was Necker was cheap, but some of the others are cheap when you adjust for the likely value, the appraisal value of the land or something like that. Real estate things can be hard that way. It's always helpful. It's much better to buy. It's usually better to buy something that's very, very cheap on the on like an earnings basis. But I also don't want to say that you shouldn't buy any asset plays when it's so obvious that they are a much better deal. I did buy a bunch of Japanese net nets and they did great. And lots of people could have gotten like 30 to 50% a year returns for a couple of years in Japan.
And you did that as a basket.
Yeah, buying like
which did you? No, I don't even know this. I'm not just asking it. So did you structure it as like a one? Was that your full portfolio, or did you say, okay, I'm going to dedicate one position, and then from there I'm going to pick, 13 positions to go?
I decided that I want to put more than 50% into Japanese net nets.
Got it. Okay.
And I tried to put 50% into them. I didn't quite reach that because of just not being able to buy them quite fast enough and other positions going up at the same time. But I got very close to buying 50%. 50% is sort of like, for my own personal thing, I don't want to go over no matter how much I like a stock. So I felt that Japanese net nets as a group, I liked this more than any stock I could imagine. But I still didn't want to exceed 50%. And remember, I wasn't hedging the yen, so you don't want more than 50% exposure to one currency probably.
Okay, so that hits on Necker. Now, what about NACO? You referenced that in the beginning.
Yeah, I don't think NACO was a mistake.
No.
And we still own NACO. But it went down. But I have to say, it also went up in a way that I didn't think made a lot of sense.
But I asked you at one point, I'm like, why do you think it's going up? You're like, I really don't know.
Yeah.
It was just ripping into the end of
it went up because, in part, probably because of an agreement that they had for a lithium mine thing.
Yeah.
I don't want to get into all the math of it, but I kind of priced out what I thought the present value, as people would say about it was, because there's no revenue that will come from it for several years. Yeah. There has to be some probability that it won't work out. It's a new method. Not that isn't going to be successful. All the sorts of new methods for extracting lithium are going to be happening around the world because we don't produce enough of it now. So there will be new things being done like this. But I just mean it's not like this is the 100th mine that someone's done that uses this process. And the company that is going to operate the mine is not like, this isn't, like Rio Tinto doing it or something. I mean, this is a company that has, speculative sort of financial situation as you usually do when you're, don't have mines up and running yet. You own them and you haven't got them producing yet. So because of that, there's some probability it won't ever bring in money. It may be a low probability, but it's a probability. You have to factor that in. Plus, you have to factor in the time value of the money, that you're not getting anything in for several years. NACCO puts up some money up front for buying the equipment and stuff, and then gets paid back right away from it. When I did all the math on that, the per share value of it, even if it's like a 20-year deal and it could be extended to be a 40-year deal or something, because the mine could have a 40-year life. I think they estimate the mine life will be close to 50 years. Even if you do that, I get a price of, dollars per share, not tens of dollars per share, to be honest. And the movement in the stock was way too big. We could argue about exactly what the value could be of it, but it couldn't be the value that the stock went up. Yeah.
Sure. Yeah. And I would agree with that. What other mistakes do you think you have made in 2019 when it comes to like a process? Do you think you've made any mistakes? You've been doing this for a very long time and you've always kind of kept it the same way.
I've changed some things about the process over time. Yeah, I think I've made mistakes. Yeah, with the process.
So like what?
I'm always frustrated that I don't find enough of the ideas that I like.
Okay.
And you know what those ideas are. I would prefer to have a lot of ideas where I like the business. I know that I want to buy things on the basis of in 10 years, it's going to be worth a lot more than it is today. I could hold it for 10 years if I need to, but the other people could discover it. It could be like the NACCO thing where suddenly they like something about it. They like lithium or whatever, and the stock starts to move and you sell it in 3 years. But I always want to go in on the basis that this is a business that I'm investing in, not an asset or something. And I'd be happy to own it for 10 years. Not just happy, but I expect to beat the market owning it for 10 years.
Yeah.
And we find some of those, but we don't find a lot of them.
Now, what are the characteristics of those type of companies?
They have to have an adequately high return on capital. It doesn't have to be 200%, but it has to be approaching 20%.
Okay.
They have to have a high growth rate. It doesn't have to be 20%, but it maybe has to be more like 10% than 5%.
Yeah.
Otherwise, the price would have to be pretty low for it to work.
So revenue growth rate, free cash flow, what are you thinking?
Yeah. So it has to have a good return on, basically it has to, for it to be worth a lot more in the future than it is now, it has to have a good return on capital and the ability to put new capital to work. Or just the ability to grow without any new capital. And you know which ones those are and stuff. And so those are generally service type businesses.
Yeah.
They're businesses that have some aspect of float or something like that. They're usually businesses that have incredibly high customer retention rates. But then there are also businesses that aren't like a dying industry or something. What I just described, all those things apply to NACCO. We like NACCO, but NACCO is heavily exposed to coal stuff. They are trying to get into other things, but that's absolutely, that's not the same as being a company that's a bank or something. A bank will be around in a way that coal won't be in 100 years. And we're not investing for 100 years, but it helps to know something will be around 100 years to be very sure that it'll be around in 10.
Sure.
Yeah.
No, I think that's a good point. So I guess what can we do to mitigate against these mistakes and your thought process on, finding companies where you feel like they truly could be around for 100 years, or you truly can close your eyes and feel comfortable that they're going to, do well for the next 10 years?
Well, I spend way too much time on stocks that aren't as good as what I just said, aren't businesses I want to own for 10 years, really. The two things I talk about sometimes is that we want to be a stock that we own for 10 years. But the other thing that I talk about, which is really how I think about it, is always, if you offer to me this stock as a private business, would I buy it? Would I at least be very interested in it, want to do the scuttlebutt, figure it out, whatever?
Yeah.
So the kind of thing of like, would you put in a huge part of your own net worth into this kind of thing? And like a bank or something, I would.
I call it the grandma rule.
Yeah.
Seriously, the way I think about it is my grandma living on fixed income, in retirement. If she gave me, would I feel comfortable putting, make this a large position for her?
Yeah. And so we spent a lot of time looking at things that
you don't want to upset grandma.
That are, Pabrai talks about, is it Pabrai that talks about cocaine brain?
Yeah.
Right. Yeah. Things like that.
Or is that Munger? One of them.
They're very cheap. They have some sort of catalyst or something. They're a lot of times the kind of thing you'd find in Value Investors Club. They may work out great, but I know that for my style and stuff, they're not the thing that I would focus in on first.
I feel like Value Investor Club, it's a lot more, next 2 or 3 years.
And it's meant to be that way.
As
They're meant
opposed
to
to
have a
next 10
catalyst
years.
thing. Yeah. It's
well, I
meant to
mean,
be
special situations, that's the way it is.
Yeah. Yeah. Which is not generally how we want to think about those things. I prefer not to do any of those. I really would. I would prefer to only be invested in companies that I would like to own for 10 years. The problem is without relaxing on price a lot, it can be difficult to do that. And we're very concentrated compared to most investors, so we even don't need as big a list. But it's still hard because you'd have to compromise a lot on price, which you want to be careful about.
I mean, in theory, how many ideas do you think we have to come up with a year for it to be productive?
2 a year would be fine, and possibly 1 a year can be fine if you don't make like any mistakes in what you're picking, then 1 a year is fine. But you got to take into account you'll make some mistakes, and also some things that you want to own for the long term will get expensive or get bought out or whatever. So probably 2 a year. Yeah, we need to find about 1 every 6 months.
Do you ever compare like stocks when you're reading to, like, if you're studying a new company, do you compare in your head to other great businesses that you are very familiar with, just sort of to weight it, Yeah,
all the time. We were talking about a bank recently that we were interested in. And a main part of my comparison was comparing it to Computer Services, which is a stock that we owned before. And I thought about it, and I thought, well, why am I not buying this stock right now, this bank? Is it just because it's a bank? Because it's a fairly safe bank. I mean, it's compared to other banks, it's very safe. It's overcapitalized. It has no loan losses, and it's recent history. I mean, it's going back a decade or more. It's not as safe as a service company because it is using leverage and is taking risks that a company like Computer Services, which just provides technology stuff for banks instead of being a bank. But on the math, is it going to grow as much as Computer Services? It'll grow faster. Will its return on equity be the same or higher? It'll be close. On like a cash basis, it'll probably be the same. So when you do that math, you go, oh, well, this should really be as expensive or something like that. And if it's trading at a big discount, then you should buy it. I do that all the time where I think, well, should I buy something that's equally good and at a much lower price, or buy something that is at the same price but obviously a lot better?
Yeah, and I do that too. I mean, I was on Value Investors Club, and I read a write-up, Nucleus Software Exports, and that this company operates in India, and it reminds me incredibly of CSVI. Now, unfortunately...
It's an Indian stock.
I don't think we could buy it.
Yeah.
But if anyone can buy Indian stocks, definitely take a look
Indian
at this.
citizens can. So people listening to this are Indian citizens, I think, don't have any problems. I don't know all the rules, but I think Indian citizens, even in other countries, shouldn't have a problem.
Let's see. I can read you guys the first opening line of this investment summary. Nucleus Software is a niche Indian IT services small cap that is currently available for approximately 18 to 20% free cash flow yield, as its stock is at a 2-year low, while revenue and earnings have grown during this period. And the business itself reminds me a lot of CSVI. And from this post, I think he talks about, that management owns, a lot of the company, high customer retention rate, like very much the picture of something that we'd definitely be interested in learning a little bit more about. But unfortunately, we can't buy it. But there you go. Maybe if you're an Indian citizen and you want to look for a new company, maybe look at that. I don't have any opinion on it other than from a bird's eye view. It looks like something that we would be interested in if we could potentially buy it.
Yeah, so I spend way too much time looking at an early stage at things that I think probably aren't the best. They shouldn't be in my top 5 of the things that I'd want to own. If they aren't in the top 5 of what I want to own forever, or like on a continuing basis, then they probably shouldn't be something that I'm considering. You brought me a thing recently that was a retailer. And with some debt.
Which I would never bring him a retailer unless I thought the situation
was a special situation.
Was interesting.
It was an extreme special situation. But I don't think that we would. I don't think that either of us thought that it'd be something that we would want to buy and own for 10 years.
No.
From everything from the management to what kind of business it's in to the financial leverage.
Yeah.
So it's the kind of thing that it excites you and you get interested in it, but you're like, well, I really shouldn't be spending time on this.
Yeah.
And the same thing's true even with things like people ask questions a lot about like KLXE, which we talked about a little bit or something. It's just the sort of thing that we tend to pass on because it's not that it's not that it might not on the probabilities be attractive. It might be. It's not the kind of thing that we feel that we can value and invest in for the longer term and hold as a bigger position too. The same thing would be true with like NACO versus Hamilton Beach brands. Like, we talked about Hamilton Beach brands. People ask like, why don't we own it and stuff? It's in a business that I know I'm less likely to own for the long term. Sure. So for people who don't know, that's the company that does small appliances selling through things like, Walmart and Target and Amazon and stuff. And so it would be the things that are, microwaves and crock pots and all that sort of stuff. It's just a competitive sort of thing.
But I guess we're able to do that because, we run such a concentrated portfolio.
Yeah.
It'd be totally different. And we've talked about this before. I mean, there's so many ideas I come across. I'm like, hey, if I was running, 50 to 60 stocks or even, 30 to 40 stocks, would I own a piece of this? Yeah, maybe.
Yeah. And that can work sometimes. I found the reason why we have such a concentrated portfolio, honestly, is because I've slept the least well with the most diversified portfolio. Diversified in the sense of holding the most positions. Yeah. I do like to be diversified in the sense of what kinds of risks you're taking. We've talked about this before, but like if we like a bank, honestly, if we have a bank already that we know that we love and we're going to buy, we don't spend a lot of time looking at another bank because the truth is we're not going to own two banks.
Yeah. Sure.
So I like that kind of diversification where, when someone brings me an idea that's like a UK idea, we already own a stock in the UK. I don't think that we're going to have two positions in the UK. The only country that we're likely to have multiple positions in is the US.
Sure.
Our clients are in dollars. So we do diversify, but not like that. Yeah. And, but that's an interesting question because we've talked a little bit about like, was it a mistake to not trim back a position that became a bigger part of people's portfolio because it went up more. Sure. And we've talked about that. And a lot of people do trim them back.
Sure. What, I guess in closing, what are you going to do in 2020 to ensure that you have learned from past mistakes, I guess? Since we're kind of talking about mistakes that were made in 2019.
I mean, we have a website that I write things up on. So probably what I will do is I'll write up more things regardless of the price, which means that I'm interested in the business, but I might not like the price. And if I write up a lot of them, we were saying do 2 to 3 a week or something. Well, if you do 2 or 3 a week, that means I'm doing 100 and some a year. If you do that, then odds are that the odds are that a couple dozen of them potentially will have moved enough in price that you'd be interested, especially if it's a year where the market's down a lot or something. You could have dozens that would be interesting. So focusing on things that may not be immediately look like something that I would buy now, not thinking about price, but instead thinking just about, is this a business I want to own for the next 10 years or something? Yeah,
I think that's good. Well, I want to thank everybody so much for tuning in with Mr. Geoff and myself. If this is the first time that you are tuning with us, be sure to check out all of our work. We have 150 plus podcasts. Can't even believe it. We've been pumping out a ton of content, 3 podcasts a week. If you're watching us on YouTube, if you found us because of YouTube, this is probably the first time that you're listening to us. Hit that subscribe button, thumbs this video up, leave us a comment. Let's get those the comments. That comment section. Let's get it talking. Okay. Yeah. Leave
Be
nice
careful
comments.
what you ask for.
Yeah. Leave nice comments. Anyways, want to thank everybody so much for tuning in with us. Check out all of our work. Like I said, go to focuscompounding.com. Geoff writes about 3 different ideas a week, and then join the Gannon Gazette. We're trying to get that email list up. A lot of people like it. We give away a free write-up from the website every 2 weeks, and then we also have a table there with price targets of when we'd be interested to revisit the stock. So I think a lot of people like that as well. I want to thank everybody so much for tuning in. We'll see you in the next podcast. Take care. Hey, this is Andrew Kuhn, and that was the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along.